If you're going to be an investor that finds asymmetric returns, you need to understand the strategy that managers are implementing and founders are implementing to drive 10x, 100x, 1000x returns from starting those businesses. One of the companies that I think has phenomenal potential is HIMSS and Hers. And it's not just about the company's recent growth, 111% growth in the first quarter of 2025. It's not the fact that they think that they can grow to $6.5 billion in revenue by 2030. I think that's even sandbagging their targets. What I love about the company is how invested they are in disrupting the status quo in healthcare. If you look at HIMSS and Hers strategically, they're following a playbook that has been executed by companies like Netflix, Amazon, and Facebook, or now Meta platforms. You may call this aggregation theory. That's what Ben Thompson calls it. I look at it through the smiling curve. These are relatively simple concepts. The challenge is finding them and then investing in them early. I think HIMSS and Hers has massive potential. And CEO Andrew Dudum, during the first quarter of 2025 conference call, actually outlined this extremely clearly. So I want to go through exactly what he said that made me so bullish on HIMSS and Hers coming out of that conference call. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. The important thing to understand about these business strategies, whether you're talking about aggregation theory or the smiling curve, is that the power in the business lies with demand. This is very different from what we had in the 70s, 80s, 90s, when supply had all the power. Think about going to a grocery store or a liquor store those days. There was no small local or niche products. It was all big brands. It was Procter & Gamble. It was Budweiser. Supply owned the power. They had the ability to advertise through big media, through television buys and radio buys. What changed with the internet is that suddenly demand became the point of power. And if you could aggregate that demand, if you could pull a whole bunch of demand together, suddenly you had a lot of power in the market. Netflix, for example, they pull together millions and millions of subscribers. So when Disney or HBO wants to reach more subscribers, wants to generate revenue from the content that they're creating, how are they going to generate their revenue? Are they going to build their own streaming service, or are they just going to take a check from Netflix? Even Disney, before they launched Disney Plus, just took a check from Netflix and distributed their content that way. But then who does that power aggregate to? It aggregates to Netflix, because Netflix is the one that customers are interacting with. They're not interacting with Disney. They're interacting with Netflix, and they choose to go to Netflix time and time again. This is the best sign of success. Who are companies choosing to interact with in social media? It's Meta platforms, Facebook, Instagram, WhatsApp. Who are they choosing to interact with when they go shopping? It's companies like Amazon or Shopify. This is aggregation. And that's exactly what HIMSS and Hers is trying to do in healthcare. Let's go through the quote that I'm talking about. And this started with a question from an analyst. He says, can you talk about your willingness or ability or desire to at some point take insurance? It seems to me like if you were taking insurance, you would potentially be more aligned with drug makers when the price of their branded products are fairly high, because the members could then have those products covered by insurance and out-of-pocket costs wouldn't be so high. This is a pretty logical question. If you are looking at the healthcare industry as it stands today, why wouldn't you want to tap into insurance? Of course, that's going to be the best place to bring more customers in, to bring more money in. And in that case, what we're looking at is a world that's driven by supply. Who has the power in that market? It is companies like Eli Lilly and Novo Nordisk. That's why you can see there he asks about Lilly Direct. He is of the mindset that Lilly Direct has the potential to attract customers because he thinks that the power is with supply. But it's not. And that's exactly what CEO Andrew Dudum says right here. I have a very, very low interest in figuring out how to integrate insurance, and I think there are a few reasons. But mostly it's because it's extremely complicated and extremely inefficient for consumers. And he goes on to talk about how inefficient it is for consumers. But look at that focus. The focus is on the consumer. The focus is on HIMSS and Hers being the point of interaction with the consumer and providing the best possible experience for those consumers. That's the same thing that all of these other aggregators that I'm talking about have. They're not trying to screw consumers. They're not trying to squeeze more money out of them. They're trying to provide the best content, the best quality, the best products at the best prices that they possibly can by squeezing their suppliers. And this is really the free market approach. He goes on to say, I think consumers having choice, selection, using their cash when they want a service is going to be the gold standards, because it's a capitalistic environment where competition will drive great quality experiences. It will drive down costs and ultimately drive great, valuable places for those people to put their money. Here's the aggregation point. Dudum says the pressure on that HIMSS and Hers is putting by aggregating millions of patients who need choice, I think, is a huge component of why some of the most important medicines of the last decade and probably the next decade are now being priced in the hundreds of dollars, not thousands of dollar range. There's that aggregation work. HIMSS and Hers wants to aggregate demand, especially in the cash pay business. Insurance companies have basically aggregated demand on the insurance side of the business, but they're basically working with suppliers. They make more money when suppliers make more money. HIMSS and Hers has a completely different set of incentives, and they're trying to bring that to bear by aggregating that demand. Look at how much demand they have. They now have 2.4 million subscribers on HIMSS and Hers. And that may be a small number today, but you might remember Netflix started with a very small business when it started streaming. It didn't have a lot of power until the mid 2010s. So HIMSS and Hers has 2.4 million subscribers today, but what are they going to have in 2030? What are they going to have in 2035? 10 million, maybe 20 million? Pretty soon you're bringing big numbers to the market, and you're the one that suppliers are coming to saying, can we get access to your customers? They're aggregating demand because now in the world of the internet, the point of power is with the companies that are pulling that demand together and making those customers happy. That's exactly what HIMSS and Hers is doing. That's why this is such a potentially disruptive company. And Andrew Dudum articulated that that's why they're not interested in collecting insurance. They don't want to be part of the existing ecosystem. They want to break the existing ecosystem. This is disruption at its finest. This is the way that a founder can think about a business completely differently than a manager of a business. This is the way a new company, a startup that has different incentives than an old company, can think about a market completely different than anybody else. We are going to hear a lot over the next few years about how Amazon is getting into pharmaceuticals, about how pharmaceutical companies are going direct to customers. None of those companies are going to succeed in the way that HIMSS and Hers is, because we've seen this before. We have seen the power of aggregation. We have seen the power of what I call the smiling curve. You want to be the company that customers choose to go back to time and time again. That, I think, is becoming HIMSS and Hers, and that's going to give them an incentive and the economics to provide more products, to provide a better experience, to provide more services, and to pull even more supply into the system. All of this is a virtuous cycle that is just getting going for HIMSS and Hers. That's why I'm so excited about the company, and Andrew Dudum is articulating exactly why they are going to succeed long term. So hopefully this is helpful in understanding this company. I think about it a little bit differently than a lot of investors and analysts do, but I'm taking a long-term view. What is HIMSS and Hers going to look like 10, 20 years from now? I think there's a lot of signs this is going to be a Netflix in healthcare, an Amazon in healthcare. Those are really, really valuable companies. HIMSS and Hers still has a market cap under $10 billion as I'm recording. A lot of runway ahead. But let me know what you think about HIMSS and Hers stock and my thoughts on their strategy. Leave those comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.